Hi everyone, thank you for joining our webinar today focused on European distribution and everything that comes with that, particularly focused on US managers who are looking at coming into Europe and looking at what different investors in Europe are actually looking at in terms of products, new strategies. As an industry, we spend a lot of time talking about structures and operating models. So it's great to actually focus more on what are the investors actually looking to buy and where they're looking to buy it and what products are doing well in the different markets. As part of the conversation, delighted to be joined here in Waystone's New York office by Charlie Bailey, who is the co-founder of Daimer Bay Capital, who are a specialist European distribution firm. So he's going to take us through all things Europe, all things European distributor, or all things European investors, and what they're looking at buying these days. So, Charlie, welcome into our office. Thank you for joining today.
And thank you for having me, and thank you for dialing in. Much appreciated. So maybe I spend 2-3 minutes just talking about Daimer Bay Capital.
That'd be great.
We can dig in and speak a bit about what we're seeing in the European market at the moment. So I co-founded Daimer Bay Capital back in 2018. So we're a third-party fund marketing firm. So we're headquartered in London, but we have offices in Amsterdam and also in Switzerland. So Netherlands and Switzerland. So the three sort of key pools of capital of Europe sort of cover the EU with the Dutch office, Switzerland with the office near Geneva, and obviously London as well. So we've got those three sort of key pools sort of covered off. I guess where we sit as a business, I mean, obviously Waystone are on the sort of operational side of things and that side of sort of UCITS funds and other fund structures. We're the active outsourced sales and marketing team. So we're sort of out there, our boots on the ground for our partner fund managers, knocking on doors, burning shoe leather, speaking to allocators across the spectrum from, private banks, family offices, pension schemes, about our partner fund managers' strategies. So as far as, where we sit, I guess our philosophy when we set up the business, in 2018. And I guess the reason we set up was we felt that, with cost pressures in the industry, we felt asset management businesses were outsourcing more and more and more. We felt the next logical thing for asset management businesses to outsource would be sales and marketing. So there are a number of third-party fund marketers out there and some very, very good ones. But there's also a sort of long tail of sort of one-man bands, unregulated one-man bands. So I guess our aim was to be like that good end of the spectrum. So, fully regulated in all the markets we operate in, high technical expertise of all the strategies we work with. And I guess another key tenet of what we're looking to bring to the market is a very high activity approach. So, with all of our partner fund managers, including our US fund managers, we like to see ourselves as a full extension of their in-house sales and marketing team. So, when we wake up in the morning, we think they're part of their sales team. When they wake up in the morning, they think we're their sales team. So I guess that's our approach. I mean, we're the active sales and marketing team. We work with 8 fund managers currently across the spectrum from global equities, US large cap, US small cap, listed infrastructure, Asian equities, EM equities, Indian equities, European high yield, and also healthcare and biotech investing as well. The partner fund managers we work with are all in the UCITS fund space. So that's I'm sure you're all well aware, that's the sort of European vehicle that is most in demand across allocators and professional investors. But we're looking, I guess, broadening out that into the sort of private market space and private debt in particular, because we see that as a particularly hot topic at the current time.
Yeah, no, and look, what we'll do, I suppose, as part of this, so we'll take a journey through the traditional UCITS world, and if we can fit it in towards the end, it'd be good to get your thoughts on what you're hearing in the private debt space. I know there's been a lot of talk, particularly from the US, around private debt in the last number of years, so it would be good to touch on that. But maybe to kind of, you've set out where you are, you've set out kind of the different markets that you're based in. It's really the main fund buying markets. It's the markets that you're in. So you're going to be very well placed to answer my next question. But the sentiment of European investors at the moment, like what are European investors thinking at the moment? It's been obviously a very unusual start to the year in terms of markets. we've seen a lot of different things moving in the US that move maybe different in Europe, or are equally have an impact in Europe. What are you seeing? What are investors thinking?
So I think high level, I think one very big positive is we're gradually seeing rates coming down. So I mean, the obvious thing to touch on first would be tariffs, but I think the most obvious thing to actually touch on is rates gradually coming down. So we went through this long period, when inflation spiked, after the Ukraine invasion, and the inflation that happened after that, that we saw a number of investors, a sort of big shift into money market and sort of government bond funds with that spike in yields. What we're seeing now is that gradual fall in yields, interest rates in Switzerland are now turning negative, interest rates in the UK are being cut. I think the next cut will probably come in May. Eurozone's down at sort of 2 to 3%. So the attractiveness of those, I guess, money market type vehicles is falling, which is very positive, I guess, for more risky strategies, which is obviously a positive, hopefully for the audience and hopefully for Waystone. So I think whilst there is a lot of uncertainty, the backdrop of falling rates is a very positive story. And, we probably won't go back to, I'm no economist, but we probably won't go back to 0% rates or, that environment. But the lower rate environment will be positive for riskier assets and sort of asset flows, I guess, into those equity funds or higher risk sort of fixed income products as well. So and also alternatives as well. So I think high level, the next couple of years will be more positive than the previous couple of years where we have seen that sort of move into those sort of money market funds and yields. I mean, anecdotally, we've heard this story a number of times over the last couple of years. As a couple of very large wealth managers who have all said that they feel like they're bond dealers the last couple of years. The next issuance of government bonds in the UK, gilts or what have you, people are getting a 4 to 5% return on that, and it's tax free. So when their high net worth clients call up, they, their strategy is to buy those, rather than buy a UCITS fund, they've been buying those. So it's been a I guess, lower flows into those UCITS funds. So I think that's a key positive, that we're seeing that environment fall down, which I think is a positive thing. And particularly amongst the key UCITS fund buyers in the wholesale space, so the private banks, the wealth managers, the family offices, the multifamily offices. So I think that's a positive thing. I guess the more challenging environment, and I know today, the economic data that's coming out is sort of bucking this trend, but the uncertainty caused by the sort of tariff story. So I guess that's caused what we've seen with that uncertainty around policy and what have you, has caused a lot of allocators to delay decisions. So delayed decisions going into riskier assets because they just don't know, what's going to happen over the course of the next, 30 to 60, 90 days or what have you, until that 90-day tariff period is ending. So we have seen that uncertainty has caused people to sort of sit on their hands to a certain degree. In some cases, we've also seen people also de-risk, I guess, their positions and de-risk their sort of portfolios as well. So I don't mean go completely de-risking going into government bonds as a result. I'm saying they're going for less high octane strategies. They're allocating in, rather than going for a high octane US large cap manager or a deep value manager, they're looking more at the core, looking to stay in the middle lane rather than going too extreme. And other end, and we're having a number of conversations in that regard. So I guess that's some of the key sentiment. I think one of the other key trends that we're beginning to see as well, which is again another positive one for managers considering Europe, is we are gradually seeing the sort of active passive debate. We're hearing sort of the green shoots of that going the way we want it to go, and the active is starting to rear its head. But in this environment where you've got quite an overvalued sort of frothy market in the US, you've got quite a lot of uncertainty on the horizon. You've got different companies have got different fortunes as a result of the tariffs, depending on where the supply chains are based or various aspects like that. making people think having a human manage money rather than having a equally weighting an index or market cap weighting an index. It's probably a better place to be.
Yeah.
So I'd say that's one of the key trends that we're gradually seeing, and you see if you read the sort of press in sort of, I guess, media written by allocators, you're gradually seeing that trend come through. That active is I think going to see a more positive environment, where it's been a bit of a challenge, particularly in the US space, particularly in the US large cap space, where you've got that narrow market that's been led by 7 stocks in an environment where you can get 5% by investing in a government bond. In all of that environment, I think it's a very positive story for active management. So I think, I would say this: it's sort of a barber asking for a haircut, but it's I think I'm drinking the Kool-Aid on the fact that the environment will be more conducive to active managers looking forward, particularly in the US space.
And that's when we speak to clients, when we look at what products they're looking at bringing to market, both in the traditional UCITS mutual fund space, but also in the active ETF space, or in the ETF space. Active is the kind of key topic that we're seeing, bringing these new products in with that secret sauce. And you see some regulatory change, for example, in Europe recently around, and not to go too deep on ETFs, for example, but on semi-transparent ETFs to protect that, because that was one of the big concerns of these active managers, that kind of how do we protect what we're doing, because active is what people want, but we want to differentiate. One of the big things in Europe, maybe different to the US, is that Europe is a more fragmented market. So you have very different buying patterns right across the continent and in the different jurisdictions. What are you seeing do well where? So when we kind of look at Central Europe, the DACH region versus the Nordics versus Switzerland versus the UK, being the main fund buying markets, if you want, what are you seeing doing well, and where are certain products doing particularly well, from what conversations you're having?
Sure. So I think if we go down different market channels, to a high level and sort of longer term, I guess the pension scheme market, UK pension scheme market, is one of the biggest in the world. I mean, sort of anywhere between 5 and 10 billion. That market is a big bar of bonds, de-risk pension schemes. They're typically at maturity. They're not big allocators. I think they're later stage than US pension schemes. So US pension schemes are, I think, at earlier stage in that sort of de-risking cycle as they sort of reach the end game of the DB pension scheme market. I think the UK is further along, so a lot of it is LDI, fixed income, bit of private credit. So a lot of liability matching. So unlike the US, where I think there is still demand for equities and active equities in particular, the UK market and UK DB market in particular, they typically do not buy active equities. And I say do not, there's a very small slug of capital that's allocated to active equities in that space. So I say in the UK, the big active equity buyers are what we call the sort of wholesale market, so the aggregators of private wealth. So that's anything from private banks, fund of funds, family offices, single family offices, wealth managers. In the UK, there's a segment of the market called discretionary fund managers, which is a sort of fund of funds type vehicle, and that's I guess the key buyers of sort of active equities. On the continent in Europe, one thing to add actually on the pension scheme side of things, the open-ended pension schemes, DB pension schemes, so things like the local authority pension schemes or the government pension schemes in the UK, which are very big pools of capital in the UK, they still buy active equities, despite the sort of corporate pension schemes.
Yeah.
It's diminished massively. In continental Europe, the Swiss market is mostly made up of there's a few very big corporate pension schemes, but then, as you can imagine, in Switzerland, there's private banks, family offices, quite a huge number of single family offices, a huge number of multi-family offices, as you can imagine, and those across those family offices, those private banks active equities, alternatives, and with the ultra high net worths, it's the private debt side of things and the private markets side of things. If we then go into our other key regions of the Nordics and Benelux, and also Germany. So Benelux as a region, Netherlands in particular, is dominated by a handful of incredibly large pooled pension schemes. Very similar to the Danish pension scheme, which is also the same. And those are buyers of active equities. They have positions. Some of them have in-house equity teams, others outsourced to fund managers. Those large pension schemes won't typically buy UCITS funds; they'll have SMAs. But then in the Dutch market, there's a handful of big wealth managers, like the Kempens and the Van Lanschot Kempen, and a few sort of family offices as well. And the Belgian market is quite similar in that it's dominated by wealth managers who will buy UCITS funds, wealth managers and family offices. I guess the Nordic market, so Sweden, Finland, Denmark, and Norway, that market is a bit more of a hybrid market. So it's unlike the UK market, which is very intermediated by the pension consultants. The Nordic market is unintermediated pretty much. So you have very large pension schemes that, the well-known ones in Sweden, like the AP pension schemes, the enormous pools of capital, or the Finnish pension schemes as well. But then you've also got a huge wealth management market there and big family office clients up there as well. So and across those, it's there's demand for active equities across those markets, and also fixed income as well. I guess talking about the current environment, so what we're currently hearing specifically as far as demand's concerned. So I think I touched on this before, that people are less, given the sort of uncertainty. We've got that greater demand for more in the US large cap space in particular, looking more for that US large cap core offering rather than something that's style extreme. Is one key theme that we're seeing, and we're seeing that a number of places where family offices, big multifamily offices have done searches where they're pairing an S&P tracker with a US large cap core manager. So that's their US large cap exposure. Similarly speaking, fund of funds looking at adding a US core manager to pair off with a deep value and a high octane growth manager. So we're seeing these searches come out. It's a prevailing theme very much at the current time. I guess moving away from the US, looking at Europe. So Europe's been pretty unloved for a few years, and we're seeing quite a lot. Unfortunately, we don't work with the European manager, but we're seeing a lot of demand for capital coming into Europe at the moment. You see the defense stocks, you see how undervalued a lot of European equities are, particularly in the small cap space. We're seeing that gradual push into Europe. Speaking of our home market in the UK, I mean, you're seeing a lot of value plays of people looking at the UK market too. So I guess looking at that so Europe is one of those where we are seeing an increase of sort of attention. Touching on EM, because EM's I think a very interesting space at the moment. And it is a real mixed bag, because we've touched on before, that the searches we found coming out the woodwork. We've had a number of conversations in the last couple of weeks with allocators in the UK in particular, where people are beginning to look at EMX China again. This is something we thought had gone away. Sort of after the China rally, people thought, right, let's leave our active EM manager to manage China in the portfolio. But we've heard of a number of allocators who've got active searches in that EMX China space, just to manage that risk of what could happen in the discussion between US and China around tariffs and what could happen there if the trade war escalates or what have you. I guess looking a bit under the bonnet with EMs, India is a real bright spot. So Indian equities and India searches, we've got a lot of interest in that space. We work with an Indian equity manager, and I guess the I guess the structural story behind the Indian growth story. There's that one element, but then there's also the other element of the sense that supply chains might shift from China to India. You saw it with Apple.
Yeah.
Earlier in the month last month, sorry, where they're shifting their supply chains in India, and I think that's one story that people are looking to play with the standalone Indian equity allocation. So we are seeing India, come through, and I guess LATAM's, I think generally an EM manager that can give good LATAM exposure as well is also a positive. I guess to diversify away from potential risk with China should the trade war sort of escalate. So EMs are, it's across all the countries we work in. That's I guess what the key trends we see there. With regards to thinking about the fixed income space. So typically speaking, if we ignore sort of pension scheme world, most wholesale investors, big, the private banks, the wealth managers, they'll typically split their fixed income portfolios. Around about a third will be high yield, global high yield. A third will be EMD. Then about a third will be government bonds and investment grade credit, or around those sort of that will be broadly what the allocation is, and they might have some satellite positions in various other things. So across those buckets, the EMD space I think is looking, I think that's an area we're actively sort of looking at to go into. Again, falling rates is very positive for EMD. Weakening US dollars positive for EMD. So that's an area we think we'll see significant flows, because it's been a I think a rough ride for EMD flows. If you look at flows data, it's been a tough place to be, and from a performance standpoint, on an absolute basis, it's been a very tough place to be as well. So I think we'll see generally speaking, we think that EMD will be a positive place looking forward. High yield also, we're positive on that. Again, it's quite contingent on the economic environment. We're positive on high yield, and then I guess investment grade and government bonds. It's contingent on what markets which individuals.
Yeah. Are you seeing the opportunity across these different? And I think it's very helpful to understand what's working and who's buying where. But in these markets, is the opportunity coming from investors looking to reallocate and I know you touched on it previously, to kind of almost de-risk and rebalance and move to kind of like to safe harbor rather than high octane, if you want to kind of branch that way. Are you seeing that as a flow or as a trend, or is it more kind of fresh capitals being allocated to new ideas, or kind of what's creating the flows that you're seeing at the moment?
So I'd say, from a US standpoint, there is a general trend away from the US as things currently stand. That comes market valuations and uncertainty, around the implications of the tariffs on the economy, et cetera, which could obviously, who knows what the actual economic impacts will be. But that's the gradual trend. So out very high level and very simplistic is we're gradually seeing outflows from the US and into Europe, into selective EMs and selective Asia. So I'd say that's broadly speaking the trend, and into, as I say, more style neutral strategies and I guess less risky sort of strategies as well. So I think that's probably what I'd say. I think the other key trend, and we can touch on this later on, is I guess the rise of private debt and private markets generally. So I mean, we're seeing that trend as well. That it's not been I don't think it's been fast moves from the wholesale space, but we think they will come eventually. That we will see these moves into these the vehicles that are being created for private markets. So these LTIFs and LTAFs in the EU and also in the UK to cater for more wholesale investors. I mean, back in the day, it was just institutions, pension schemes that would invest in private debt. And I guess one of the key trends we're also seeing is amongst a certain segment of the wholesale market, they're beginning to be in demand too. So, and when I say a specific segment, I mean the ultra high net worth individuals, the family offices, multi-family offices. I'm not talking about, the mass affluent part of the market. I think the segment of the market where we see that demand is, the ultra high net worth, the private banks and their platinum clients, can gain access to private debt and through a fund. And you had a conversation with one of the world's largest private banks the other day, and they were saying it's the flows they've seen internally from their hedge fund book to the private debt side of the business has been enormous. So that's just anecdotally what we're hearing there. Obviously, it's a bit, you don't have flows data like you do with the UCITS fund with private markets, but that's just the sort of conversations we're sort of having there.
Okay. Yeah, so it's definitely moving. But when you think about, or when you talk to investors and you look at the products that they're exploring, what are the key performance is obviously extremely important, but what are the key kind of product features that you're seeing investors look at on a broad sweep? I guess fees, performance are obviously they're the two ones that jump out. But when we get past that, we've touched on kind of the idea of high octane performance is maybe not. Obviously everyone wants the performance to be as good as possible, but what are you seeing investors really? What features are they narrowing in on when we start to compare products, and when you start to compare kind of apples with apples sort of thing here, like what are they really starting to drill down on that?
So I think given we as a firm we've brought a few managers across to Europe and they've had successful UCITS funds in they've replicated their success from in the US over in Europe. I think there's things that rhyme amongst all of those managers. And I guess the key, like to start with, I guess the key thing with all of those managers is, I guess, firm attributes, the attributes of the company, the culture. I mean, it's very fluffy and hard to sort of quantify, but there's certain cultures, good alignment between portfolio managers and the end clients. We touched on before, two key attributes to asset management businesses, your people and the assets, and both of those can flow out the door tomorrow. So what's keeping the people involved? Like the culture, have they got ownership in the business? Is there that alignment between them and the end client? I guess another aspect from the firm side, and this is something we've seen with all of our managers, the most successful sort of UCITS funds get brought across. They typically have a very, I guess, high profile institutional client following in the home market in the US for the audience today. So whether that's pension schemes, endowments, high profile family offices, firms, that when you come and bring that UCITS fund over to Europe, the allocators can sit there in a meeting and triangulate that there has been a fund researcher who's across the other side of the pond that's done deep due diligence from an operational investment standpoint. Obviously, they're not going to rely on that, but they've at least got that comfort in their head that someone has done it and invested with that manager. So I guess that's from a firm standpoint. I mean that just sort of resonates that it's a strong, stable firm with a loyal client footprint. And I guess the other aspect is that the tenure of those clients, they do have been with them for a very long time, so that they know that from an investment standpoint, from a servicing standpoint, you get a good experience. I guess drilling down into the specifics of product itself, I mean it's very products are so different between different managers, but I guess in the equity space in particular, the key things people look for, I mean, high active share. If you want an active manager in the equity space, you want that manager to be taking bets and having conviction in the positions they have, but at the same time not having a tracking error that's too significantly large. So it's one of those where you're managing risk and also managing the position sizing in the portfolio. again, that's something that resonates across managers, and it's been a tougher environment for that, particularly US large cap, where the market's been led by 7 stocks. I mean, the active share, it's same to a certain degree, Asia with things like TSMC and other markets that have been led by a narrow number of stocks. It's tough to get that high active share, but I think that's changing with we had very different market leaders, which have enabled that. So I think active shares are a key one to consider. I think as far as product, as far as I think to the hundreds and hundreds, maybe even thousands of meetings I've done with portfolio managers over the years, the key thing is to have a very clear and articulate process that people will remember, and it's not hard to explain. So they, some sort of marketing hook in there. The people, the allocators. One thing that fund managers always have to bear in mind is the other person on the other side of the table. A UCITS fund allocator will sit in probably up to 300 to 400 meetings a year with fund managers. What is it that they're going to remember from that meeting? If it's tough to remember what the process is and what the philosophy of the fund is, and there is no marketing hook, it's going to be there's nothing for that fund selector or allocator to remember that meeting. So I think to have something just just something that people remember is what because there's a ton of great firms out there. There's a ton of great firms with great clients with all that good firm-wide stuff that I mentioned. But if you've got a poorly articulated process that isn't clear and doesn't have a marketing hook, that it's going to be a struggle.
Is it kind of fair to say then that we're nearly in a way gone full circle in that everyone's trying to be the most sophisticated kind of process story, all of that out there, but actually just going back to basics, and as long as your performance is there and you get your structure and your fees and all that right, kind of leaving that aside, a simple, well explained story and process actually gets you ahead of kind of overcomplicated black box sort of which I think is interesting, that it's nearly gone, we've kind of nearly gone full circle, because it was a stage of we don't want simple, we like this kind of this new shiny object over here, but now it's kind of going back to basics, right?
Yeah, 100%. I 100% agree with that, and I think this is born out of the era we're in, that you've got quant funds doing all of that. There may well be quant funds that have dialed in today, but you've got quant funds doing that very intelligent stuff where you may need human oversight, but you don't need human managing the money, making the decisions 100% the whole time. And I guess that's active management. You need a human who is making a call, right? Is this going to be a 5% position or a 7% position? And it's a qualitative as well as quantitative decision, and that that's ultimately it. And it's trying to articulate why that is. So yeah, I think I'd say that. I think one thing I didn't touch on was fees. I think the great thing about UCITS fund and the end goal is obviously a very diversified book of business that you can build in Europe amongst different countries, different marketing channels, whether that's the private banks or the Swiss private bank, a family office in the UK, or a wealth manager in the UK, or a pension scheme up in Finland. You can build a beautifully diverse book of business with a UCITS fund that is highly profitable and diversified away from if you've got a say client book that's US pension schemes, it provides a nice ballast, and these clients will behave in different ways. I'd say entering the market, you've got to be very cognizant of the fees you enter in with, and the key thing is getting UCITS funds off the ground. And I'd say with those, you do need to offer fee discounts. So going in with a product which has got I wouldn't be expecting the fees you charge in the US if you go in with those with an initial UCITS fund. And unfortunately, you do need to offer sort of seeding terms in the initial I guess the initial stage of the UCITS fund. But I would say the good news is there's a number of firms in we've had success with a number of the firms in London, a number of the firms in the Nordics, and we sort of know all the key seeders across those. And a lot of these people love seeding funds. They love, they're fund researchers. They want to find new, interesting ideas. That's the purpose of their job. So a lot of them really enjoy finding, the next boutique manager that they can put in their portfolio, and so that their portfolio looks different from their competitors. and they love the idea of having that for that manager that becomes a 10 billion UCITS fund. They got in day zero with good fees. So there is that sort of, I guess, it's some fund researchers absolutely love it. So it's I'd just say that as a caveat with actually entering the market on the fee side of things, that the initial, I'd say 100 million is a lower fee.
Yeah.
But once you're past that, it's
and that kind of that resonates with the message that we share with our clients when they're looking at going into Europe, is that it is an investment. It's not a kind of build it and they'll come and you just let it sit there and you collect the check as it comes in. So that does resonate, that kind of fee discounts and investing in that. This is a process. It takes time, it takes effort, it takes money and resource. But it is interesting to hear that there's people seeding, because the biggest challenge that we have, there is a lot of managers that we talk to here in the US who have great product, great story, great process. But when we look at this with them, is what's your seed, and the kind of seed story for us is as close to 50 million as you can get, and then what's your short-term journey from 50 to 100, because that 100 million is kind of that puts you into the institutional bucket, right? So it's kind of looking at that journey, and that's where a lot of these conversations stop, because trying to find that seed, particularly if you're the US manager that doesn't have the footprint on the ground in Europe, and ultimately that's what you guys are trying to do, but it's even trying to get that concept off the ground. So hearing that there is firms that are seeding, I think that's
it's I guess that's the it's, and those, it is that first 100 million that's the the toughest, but once you're past there, we've seen it with the number of our managers, when you're past there it snowballs. You start at that point, you start turning up on screens. So fund researchers will start screening, they'll screen the UCITS, like they will have a US small cap search and they'll screen the managers with over 100 million just to reduce the universe down, and you appear on that search and you start to be in the fortunate position of having inbound inquiries, which every salesperson's dream, rather than having to fight to get up to that 100 million.
We can't talk about European funds without touching on ESG, everyone's favorite topic. It's been a bit of a changing landscape in Europe, where it was when kind of SFDR and the different framework came out originally, there was a jump to Article 9, so kind of super ESG funds or dark green funds, if you want to bracket them that way. That obviously has kind of moved a little bit. What are you seeing with investors in terms of the want for ESG or for sustainable products, the kind of request for it? Is it as much of a talking point as it maybe it was 18 months, 2 years ago, or is it still very much in the forefront? And I know that you go to the Nordics, for example, and ESG there it's bread and butter stuff. It's kind of they just expect. But in other markets, what are you seeing as a general?
So it's a very relevant question. ESG and sort of sustainable investing. I guess if we tackle it first, is sustainable investing. So specific sustainable funds. So funds that have a sustainable angle. I guess the demand for those is, quite frankly, it has fallen in the last couple of years. We've seen a decline. We've seen a number of fund closures. I guess the key driver is that has been underlying, sort of investments in that space. The demand's fallen, and I don't know if is that a fall in demand for sustainability, or just the fact that sustainable strategies with higher interest rates of their longer duration assets has that negative performance impacted the demand? I don't know, but the long story is, the long story short is the sustainable sort of portfolio. So out of London, there's a number of sustainable fund of funds. There's a lot of wealth managers will have sort of sustainable buy lists where they'll recommend certain sustainable funds, and those channels, the demand for the sustainable focused strategies has really fallen. It grew enormously from sort of, I guess, 2016 to 2022. But since then, we have seen that drop off. My long-term view, if anyone cares, I mean, I think it will be, I think structurally I just think with the wealth transfer from a generation, to the generation who I think does care a bit more about sustainably focused strategies. Not to say the generation above don't, but like I think the current generation, maybe as that generation wealth happens, I think there will be, will resurge. I just think there's been a sort of cyclical blip in the demand. So that's as far as the sustainably focused strategies are for. As you rightly said, the Northern Europeans, there is a greater demand for those strategies than say UK and Switzerland. So the Germany's, Netherlands, those markets in the Nordics, the Finland, Sweden, Norway, and Denmark. There's demand for those sort of strategies, I guess, greater than the UK and Switzerland. I guess the second side of it is, how do you tackle ESG within a fund? So within a normal, say, US large cap fund or a US small cap fund or any sort of fund, what should you think about with ESG? And I think from our perspective, if you actually look at the landscape, all of the wealth managers, the private banks, all of the big players in the market, the pension schemes across UK, Switzerland, the Nordic countries, they have responsible investment teams. They have analysts, and whilst that they grew massively, but I mean they're not going away.
Yeah.
There needs to be an element of ESG integrated into the investment approach, and that's not saying you're a sustainable fund. That's saying, right, so do you have an exclusionary policy on tobacco or armaments or what have you, or do you, what's your sort of policy on shareholder, I'm not going to say activism, I'm saying shareholder sort of how do you speak to shareholder? How do you raise issues with shareholder? What's been your voting record and things like that? So I think you'll be asked those questions. So that there needs to be, if you want to win assets in amongst some of the larger allocators, the big usage allocators, you need to have that integration of ESG. And I think our sense is always that it has to be as authentic as it possibly can be, and as true to the firm's policy and culture as it possibly can be. And I think if it's frankly, it just wouldn't fly, if I'm being completely candid with you, if there was no ESG policy or no integration of ESG in Europe, it would be a struggle to win, to have a multi-billion US dollar UCITS fund. You might get a couple hundred million or so, but actually getting past that, I think, is key. I guess then going on to SFDR, the UK, if I'm honest with you, the UK is very qualitative over how it looks at ESG. It just wants, the key allocators we speak to in UK, they want integration of ESG. They want an authentic approach to ESG. They, want some sensible exclusions in there, but they're largely ambivalent about whether it's Article 8 or 6. It's not a red line by any means. I'd say where where ESG is Article 8 is more of a prerequisite is the Nordics, Benelux, and also Germany. So those markets, you'll be cutting a significant part of the market out if you're not Article 8 fund in those markets. So I guess I think one of the key things, and we obviously have a number of live dialogues in this regard, is how you manage that between, I guess you've got two sides, and I don't want to get political at all, but how you manage that between Europe and the US, and how you manage that policy between potentially an ESG policy for Europe and an ESG policy for US, where there is there's differing sort of demands. But I'd say ESG, I'd say it's still important in these markets. I guess the wealth managers, all of these groups, that the allocators and the gatekeepers, they see themselves as the custodians of their clients' assets, and they I think there is a certain amount of client alignment in wanting to have something that's not completely anti-ESG on the wrong side of ESG. I guess that's probably how I'd summarize it.
Okay, no, I think that's very helpful, and I guess that's kind of what we're seeing as well is that you can't in Europe you can't steer away from it, that you have to have a kind of stance in where you're factoring it in be it through your policies or through kind of how you're running your business. Conscious of time, but I think one of the things that we touched on at the start was Daimer Bay's move into the private credit space, and kind of the driver behind that is really the conversations that you're having with investors and what you're seeing from different allocators. You mentioned on the private banking or the client that you mentioned on the private banking side where there's massive allocation moving over to private markets. What are you seeing kind of from investors in the space here? It's you read the headlines, you see all of the different articles about this massive flow into private markets. In some ways, it looks like the horse is bolted in one way, but then the next article you read is all of the demand is there. Clearly, that's what you're seeing. If you are kind of branching the business into the space, what are you seeing kind of on the ground direct?
So I think as far as I'm very bullish on the asset class. Drinking the Kool-Aid on the asset class, the potential for it to grow from what's 2 trillion today, $2 trillion US to, potentially 20, 30 trillion, 10, 20 years time. So I think it is going to be a massive growing asset class taking the place of, I think, more public market fixed income. So I think that, that is the key trend. I guess it has been the staple, obviously, of the institutional investors, UK pension schemes, and that particularly the case sort of, I'm just trying to think, it was probably from about 2014, 2015, continuing today, that it's been the staple of DB pension schemes. In the UK in particular, that's, the market I know the best. But I guess the key trend we're seeing is that the wholesale investor is wanting access to that. They're wanting to democratize that sort of access to private debt, private markets as well, more generally. But I think our more focus is on the private debt side of things. So, bringing that to the private banks, bringing that to the the family offices, to I guess within a wealth manager, their sort of ultra high net worth book of clients, to be able to bring product that they could do. So, bring vehicles in there that could be invested, and that's where the LTIFs and the LTAS, and I feel that we're probably at the stage where there's we're at the educational stage. When that piece is through, I think then we'll start to see the flows coming into those types of vehicles, whether across the board of different types of unlisted vehicles, and also the listed vehicles and those structures. So I think that's broadly, I guess, the rationale behind it. I guess it's that larger trend of sort of democratizing the access to private debt. I guess in the more short term, you've got the nervousness around, if something's pricing on a daily basis and it's zipping all over the place, it's that causes that, I guess that sort of uncertainty is I guess it creates more of a long-term approach if someone's not looking at the NAV on a daily basis and they're invested in a vehicle like in the private market space. I think that's sort of why we're pushing into it, and I think there's attractive returns that can come from that. As far as the sort of at the moment, it's dominated by the big names.
Yeah.
So the household, I say household, but the asset management household names.
Yeah.
It's sort of dominated by those groups. I think there is, from our conversations, the typical private debt book is 80 to 90% developed markets, typically European or US managers, and then sort of 10 to 20% Asia EM private debt. So I think there's potential for growth from the Asia EM side. I think there's also potential growth from those non-household names, more boutiques. I mean, that's sort of, with our the fund managers we work with, that's where we've sort of forged our reputation of bringing interesting boutique and specialist managers to Europe. And I think there is something to be said for doing that again with private debt. So, bringing, managers that an allocator or a fund researcher or a manager researcher has not heard of before. And so I think that's
Yeah, that's a trend that we're starting to see emerge, where on one end of the market you have the household names, the KKRs, the Blackstones, etc. And, they will always raise their mega funds, but that kind of broad sweeping private debt product it has worked very well for those household names. But I think where the boutiques seem to be doing well is where it's kind of sector focused private debt. So it's almost, you can active kind of, it's a wrong maybe analogy, but this concept of the really actively managing in a sector, in a kind of thematic sector, the private debt products, and that's their specialty, because any allocator can go and get KKR's latest greatest private debt fund that will be a broad sweeping product, but actually maybe looking at healthcare, looking at at specialist tech, looking at some of the industrial products, in kind of that's where we're seeing kind of some of these managers differentiate. So I think that boutique story, I think that there is a lot of conversation happening there. A lot of allocators are looking to find that next best. So it certainly makes sense. I can see why it's on your journey to branch the firm in. Maybe just before we wrap up, if you were a US manager, or if you were the kind of US manager looking at Europe, so we touched on our performance, we touched on our fees, we touched on kind of how you present yourself. Are they the kind of core tips, the core bullet points? Like, what are your kind of your 30 seconds?
Yeah, so I think if you're a manager coming to Europe for the first time, I mean, there's the things I mentioned before, the marketing hook, the well-articulated process, the firm, good stuff about the firm. But I'd say, as far as, the aspects of actually coming to Europe, I think one of the key, and you spoke about this very briefly earlier, but, you can't have the field of dreams mentality of, oh, you've built a UCITS fund, they'll come. It's activity. It's you've got to be on the road. You've got to commit to meeting people. Again, it goes back to, it's active management. It's a people business. People invest. The active managers, people invest with the people, and they want to see the whites of the portfolio manager's eyes. So our most successful partner fund manager relationships have been where, the early days, one of our managers, they were over every quarter in the UK, and we do a week's marketing in the early days. And, the UCITS fund, as a result, grew incredibly nicely as a result, because they're on the road meeting. We did a 2-week roadshow once with this manager, where we met with 70 allocators. I mean, in 2-week period. I mean, the portfolio manager was quite tired at the end of the 2-week period, but the activity leads to, we think, to flows if all goes according to plan. So it's activity is everything, and people start to get to know the portfolio manager, and you start to get a buzz around that portfolio manager, and people speak. It's despite asset management being a big industry, it's also a tiny industry, and people talk to one another. So activity drives the flows, and need as many shots on goal, particularly in the early days, to get it off the ground. So I'd say that that's the key thing. I think the other thing to keep in the back of your mind is that it's not a quick win. It's not, we're creating a UCITS fund and we're profitable within 6 months. It could take 3 years. It could take 2 years, 3 years to get the UCITS fund profitable. Involved in all those marketing trips and what have you. The asset class that you're in, you can't choose how quickly you launch UCITS, or unless you Waystone involved, you can do it as quickly as possible. But if you maybe the asset class you're raising in, you have no idea how long the Central Bank of Ireland could take to approve it. You don't know what hopefully the market environment is conducive at the time of launch, but you don't know. So it could take longer. The J curve could be elongated to profitability. And that's something I think you've got to hold in the back of your mind, that it's not profitable on day zero, unless you're fortunate enough to find seed capital to get the thing off the ground immediately with 50 to 100 million, and the UCITS fund is profitable on day zero, which is a very fortunate place to be. I think it is an investment that you're probably 18 months of cost before it sort of turns profitable. And we've actually looked at this with all of our managers and it is typically 18 months before you see the first significant flow into a UCITS fund. That it is sort of 18 months of meetings before you actually see that uptick of assets under management in that UCITS fund.
Yeah, and look, that I think we touched on already that it is an investment when you look at particularly coming to Europe for the first time. If it's if you're not coming with if you're fortunate to be coming because a mandate's bringing you there, brilliant. That's a great success story. But if it's kind of, we think our product might do well, here's the reasons why, and those reasons are they all stack up against the market, it still makes it an investment that is time, it's effort, it's resource, both human capital and real money. And that is something that we often speak to clients about, that this is not going to be kind of day one off to the races sort of thing. So,
but it's as I say, the end goal is that you've got a completely different client base to what you'd have in, say, your home market in the US. You've got, and we've seen this across our US managers, that their US business is typically the staple of it is pension schemes, endowments, that sort of segment of the market. They then launch UCITS funds, and yes, we may see we have brought in pension schemes, but typically it's family offices, it's wealth managers, it's private banks, and it's a very diversified client base they behave differently. They may top up in different times, they may take money out at slightly different times to what your pension scheme market would do. So it's a nice diversifier, and I'd say if you build up a rapport with the European asset allocators, that it's sticky money. I think as long as you stay true to your style, you stay true to your process, stay true to your asset class and what you said you'd do, they're a loyal group of investors. So I think it's a nice diversifier, and also within those, it's also thoroughly enjoyable. I mean, it's coming from two Irishmen and Englishmen, it's good fun marketing in London, Dublin, the Nordic countries. Whilst it can be hard yards going through the snow in Oslo in the winter, it's a great place to market and meet very interesting and thoughtful investors as well. So
I think that's a really nice tone to finish on, that ultimately while you're out doing the hard yards, you're having good fun doing it, which is that's what everyone wants to be doing. So look, really appreciate you coming in today for the conversation. It was extremely insightful. I hope everyone who joined found it equally as insightful in terms of navigating Europe and all the different nuance. But thank you, Charlie, for coming in today.
No, thank you so much. Thank you, and thank you for everyone for joining.
Thank you, everyone.